All right, so we are still on financial institutions. Now we are looking at institutional investors. So we'll be looking at merchant banks, commercial banks, micro lenders, collective investment schemes, um, collective investment schemes, and investment management companies, self-administered retirement funds, as well as life and non-life insurance companies. So those are the institutional investors. So first things first, I think maybe let me search what is an investor. What is an investor? What is an investor? So an investor is an individual or an entity like a firm or a fund that commits capital. Capital means money or assets into something like stocks, bonds, real estate, businesses, with the expectation of earning future financial returns, growth, or profit, taking on risk for potential reward, ranging from small personal investors to large institutions. Investors differ from traders by generally taking, excuse me, investors differ from traders by generally taking a longer term view, providing essential funding for economic growth and market liquidity. So, the key aspects of an investor: the goal of an investor is to grow wealth, save for retirement, fund education, or generate income over time. The actions of an investor include allocating money into various uh, asset classes like shares, bonds, property, or new ventures. And then there's also an element of risk to investment. They accept the risk of losing some or all of their initial investment for the potential of higher returns. And then there's types. Investors can be retail investors like individuals or institutional investors like pension funds, mutual funds, and banks. The role of investors is that they fuel economies by funding businesses and creating market activity. Some common examples of investment include stocks, which is ownership in companies, bonds, which is lending money to companies, and then real estate and startups. Those are via venture capital or angel investing. So, in essence, an investor puts money to work today to make money later, to make more money later, playing a vital role in financial markets and economic development. So, yeah, that's an investor, a person or organization that puts money into financial schemes, property, etc., with the expectation of achieving a profit. That is an investor. So, now we are looking at institutional investors. So, we said we'll be looking at merchant banks, commercial banks, micro lenders, collective investment schemes, um investment management companies, self administered retirement funds, life and non life insurance companies. Those are the institutional investors of interest. Okay. So, a merchant bank. Merchant banks specialize in assisting organizations to capitalize their business. The roles played by a typical merchant bank are to give advice on takeover and merger strategies and defenses, giving advice on investment projects, giving advice on black economic empowerment projects, giving advice. So, a common theme that I see on these notes is that they are all about giving advice. Okay, so they give advice on mergers and acquisitions, merger strategies, takeover strategies, and defenses, giving advice on investment projects, giving advice on black economic empowerment projects, giving advice on the best way to raise capital, acting as an issuing house, arranging underwriting of new issues, facilitating private equity transactions. So now this is very brief on the notes. I'll ask ChatGPT for some context or content. Okay, I just want to write a prompt. All right, so I'll say, hi ChatGPT. Wait. Okay. Hey ChatGPT, please explain or please expand. Please explain merchant banks, their roles in the financial markets, and how they invest, or what is their role as an institutional investor. What is their role as an institutional investor? And then I'm gonna add, like, please explain in paragraph form. Please explain in paragraph form or paragraph format. To an actual undergraduate. Add examples and scenarios. Give examples of popular merchant banks in South Africa. Give examples of popular merchant banks in South Africa and the role they play in practice. Right. No bullet points, no listings, just paragraphs that explain the concepts. No bullet points, no lists, just flowing paragraphs. Right. Okay, let's see. So merchant banks sit in a unique space in the financial system because they operate somewhere between a traditional bank and an investment bank. So for an actual graduate, it helps to think of them as institutions that specialize in helping companies raise money, restructure themselves, or execute big strategic financial moves. They typically don't focus on mass market retail banking. Instead, their clients are corporates, parastatals, private equity funds, large family businesses, and sometimes government entities. Their core function is to help organizations capitalize their business, meaning they help companies get the funding and strategic structuring they need to grow. Meaning they help companies get the funding and strategic structuring they need to grow, buy other companies, defend themselves from takeovers, or restructure their ownership. So in practice, merchant banks act as professional advisors or mergers. In practice, merchant banks act as professional advisors on mergers and acquisitions. If Company A wants to buy Company B, the merchant bank helps assess whether the deal makes financial sense, how much Company A should pay, what risk exists, and how the transaction should be financed. They also design defensive strategies for companies that might be targets of unwanted takeovers. As an institutional investor, a merchant bank may even take small direct positions in companies they are advising, especially through private private equity arms, but they usually do so as part of structured deals rather than speculative trading. For example, a South African merchant bank might help a mining company acquire a logistics firm, putting together valuation reports, structuring the deal finance, and possibly underwriting part of the capital raise. They also play a central role in helping companies design and evaluate investment projects. They also play a central role in helping companies design and evaluate investment projects. If a telecommunications company wants to roll out fiber infrastructure across multiple provinces, a merchant bank would help assess the project's financial feasibility, quantify the risks, design the capital structure, and identify potential funders. For someone with an actuarial background, this is where long term cash flows projections, risk quantification. For someone with an actuarial background, this is where long term cash flow projections, risk quantification, and sensitivity testing come into the advisory process. Merchant banks essentially translate strategic corporate plans into financially workable investment structures. In the South African context, these institutions are also deeply involved in black economic empowerment transactions because BEE deals often involve complex ownership structures, preference share funding, and long-term value unlock strategies. So merchant banks help structure these deals so they comply with regulatory requirements and are financially sustainable, right? A typical scenario would be advising a large retailer on how to sell a minority stake to a BEE consortium while ensuring the consortium can finance the deal and still realize value over time. All right, I'm gonna go consult. The merchant bank models the cash flows, arranges funders, and ensures the structure works for all parties. So I'm gonna consult Google on what a consortium is. What is a consortium? Sorry. What is a consortium? What is a consortium company? A consortium company is not a specific legal entity, but rather a temporary partnership between two or more independent businesses or individuals or governments. This is done to pool resources for a large shared project or goal, like bidding on big tenders, building infrastructure, or conducting joint research, while each member maintains its separate operations and identity. They function through a formal agreement defining roles, responsibilities, and liabilities for that specific project, allowing firms to combine strengths like expertise or capital for ventures too big or complex for one company alone. So without merging permanently, right? So the key characteristics of a consortium is that there are collaborations, not mergers. Members stay, the members of the consortium stay separate entities. They are sharing the cost, they are sharing the risk and rewards for the project only, right? And then they have a defined purpose. They are formed for a specific common objective, such as a construction project. For example, an architect, a builder, or an installer. And then they have a contractual agreement. They are governed by a consortium agreement that outlines the scope, the liabilities, the profit or cost sharing, and the duration of the contract. There's flexibility. This offers a flexible way to tackle large projects common in IT, construction, and academia. For example, university research groups. So examples of consortiums: several construction companies joining to build a major highway, a tech firm, a marketing agency, and a logistics company forming to deliver a complex service. Universities pooling library resources on or research funding. All right, so I get what a consortium is. So in the South African context, these institutions are also deeply involved in black economic empowerment transactions. We are now talking about merchant banks. Because BEE deals often involve complex ownership structures, preference share funding, and long-term value unlock strategies, merchant banks help structure these deals so they comply with regulatory requirements and are financially sustainable. A typical scenario would be advising a larger retailer on how to sell a majority stake to a BEE consortium while ensuring the consortium can finance the deal and still realize value over time. The merchant bank models the cash flows, arranges funders, and ensures the structure works for all parties. Another major role they play is helping companies raise capital. This can take the form of issuing new shares, issuing corporate bonds, arranging private placements, or structuring debt programs. When acting as an issuing house, the merchant bank coordinates the entire process of listing a new share or bond on the JSE. It prepares the documentation, works with lawyers and regulators, and markets the issue to institutional investors. Underwriting is also key. If a company wants to issue 5 billion rands worth of new shares but is not sure whether the market will fully buy them, a merchant bank may agree to buy whatever portion the market doesn't take up. This guarantees the company receives its full capital requirement. So from an actuarial perspective, underwriting requires pricing the risk of under subscription and working out what capital needs to be held for such exposure. Right. So just for completeness, what is underwriting? What is underwriting in finance? Underwriting in finance is the process where a financial professional or institution assesses and assumes risk for a fee. Underwriting in finance is the process where a financial professional or institution assesses and assumes risk for a fee, typically in loans, insurance, or investments, by evaluating an applicant's financial health, creditworthiness, or an asset's value to decide whether to accept the risk and at what price, the rate or premium. It is crucial for deciding who gets a mortgage, insurance coverage, or for pricing public stock or debt offerings by gauging investor interest and risk, ensuring fair rates, and protecting against losses. How it works in different areas. In loans or mortgages or vehicle finance, an underwriter reviews your income, your assets, your credit score, and debt to income ratio to determine if you can repay the loan, often using property appraisals to confirm collateral value. In insurance, insurers assess a policyholder's risk factors like health, lifestyle, property condition to decide whether to offer coverage and set premiums that reflect that risk. In securities like IPOs or bonds, investment banks, the underwriters, help Investment banks, the underwriters, help companies raise capital by buying new stock or bonds and selling them to investors, guaranteeing the sale and pricing the offering based on market demand. So the key functions of underwriting is risk evaluation, analyzing data to quantify potential financial losses, pricing, setting appropriate interest rates, premiums, or offering prices, and then risk mitigation, protecting lenders, insurers, investors from bad debt or poor investments. So, in essence, underwriters act as gatekeepers, managing risk for financial transactions, ensuring stability, and facilitating access to capital or protection for individuals and businesses. All right, so that was a side tangent. Back to the notes. So another major role they play. So I was saying in the South African context, these institutions are also deeply involved in BEE transactions because BEE deals are often complex. Merchant banks help structure the deals so they comply with regulations and financial sustainability requirements. A typical scenario would be advising a large retailer on how to sell a minority stake to a BEE consortium while ensuring the consortium can finance the deal. All right, another major role they play is helping companies raise capital. This can take the form of issuing new shares, issuing corporate bonds, arranging private placements, or structuring debt programs. When acting as an issuing house, the merchant bank coordinates the entire process of listing a new share or bond on the JSE, prepares the documentation, works with lawyers and regulators, and markets the issue to institutional investors. Underwriting is also key. If a company wants to issue 5 billion rands worth of new shares but is not sure whether, so underwriting, this is where I stopped. Underwriting is also key. If a company wants to issue 5 billion rands worth of new shares, but is not sure whether the market will fully buy them, a merchant bank may agree to buy whatever portion the market didn't take up. This guarantees the company receives its full capital requirement. So, from an actuarial perspective, underwriting requires pricing the risk of undersubscription and working out what capital needs to be held for such exposure. So, from an actuarial perspective, if I'm understanding this correctly, is that because if a new company or if a company issues new shares to the market, say it issues 100 shares and the market only buys 90 of those shares, the merchant bank will take the remainder, the 10 shares that the market didn't take up, and this is just to give or guarantee that the issuing company of the shares receives the full capital requirements. So that is a form of a guarantee. So guarantees usually carry a risk, some form of risk, right? It could be that of those 10 shares that the merchant bank has bought, it could be stuck with those shares. Say maybe the company fails in future, the merchant bank has ownership of those shares. If it's not able to sell them, that is also some form of risk because in ideally it wanted the market to fully buy to buy the 100 shares in full. So it is sort of like an inconvenience for the merchant bank to take up the remainder of the shares that the market didn't take up. So that creates some form of risk, and then that risk needs to be priced for or allowed for. So underwriting, that's where underwriting comes in to assess the risk and price it properly. That's from an actuarial perspective. Underwriting requires pricing the risk of undersubscription. The undersubscription part, I think, is the market not buying all the shares that have been issued, and then working out what capital needs to be held for such exposure. So many merchant banks also facilitate private equity transactions. This includes advising private equity funds on which companies to acquire, structuring the deals, raising funding, and sometimes co-investing alongside the fund. They might connect a private equity firm with a high growth manufacturing company looking for expansion capital, handle the negotiation, and design the transaction structure, right? So their full function as an institutional investor becomes visible here because they invest patient, long-term capital into companies, often taking equity stakes or arranging complex financing structures that typical banks won't do or would not do, right? So yeah, okay. In South Africa, well-known merchant banking activities are carried out by institutions such as Investec, Rand Merchant Bank (RMB), and Absa Corporate and Investment Banking. RMB, for example, is heavily involved in funding large infrastructure deals, structuring BEE transactions, and advising on mergers in sectors like mining and financial services. Investec, on the other hand, often works with high growth companies and private equity funds, providing both advisory and capital raising services, right? So, in practice, these banks shape some of the country's largest corporate transactions. For instance, when a major renewable energy project seeks funding under the Renewable Energy IPP program, a merchant bank like RMB may structure the project finance, raise capital from institutional investors such as pension funds, and manage the risk allocation between the project company and the lenders, right? So merchant banks matter because they sit at the center of corporate finance in South Africa. They convert business ideas into financially viable ventures. They mobilize large pools of institutional capital and structure some of the most strategically important deals in the economy. So for actuarial students, the link is direct because the same the same financial modeling, risk assessment, and long-term cash flow thinking we learn is exactly what gets used inside these institutions to guide multi-billion rand decisions. So that is merchant banks, right? And then moving on to commercial banks. So commercial banks or retail banks carry out a multitude of roles, although their distinguishing feature is that they provide individuals and companies with banking facilities, a means for their customers to transfer money to third parties, right? Those are the banking facilities, a means for the customers to transfer money to third parties. Their clients deposit money, the customers deposit money in current accounts or saving accounts. So these are normal banks like your Capitec, Absa, Standard Bank, whatever banking account you have, it is provided by a retail bank or a commercial bank. So these carry a multitude of roles, although their main feature is that they provide you or us as individuals and companies with banking facilities so that we can transfer money to third parties. So their clients, the client of retail banks or merchant or commercial banks, deposit money in current accounts or saving accounts, and then the banks also provide deposit facilities. For example, fixed deposits, whereby investors deposit money for a specified period. In addition to these core banking activities, commercial banks offer extensive loans, including mortgages and unsecured loans. They also provide specific purpose loans such as vehicle finance, right, and home loans. So commercial banks provide a range of other services, including providing financial advice to clients. And then they have a role that they play in investment markets, money market deposits, certificates of deposits, the bill markets, government bond markets, and other roles that they play, right? So let us ask ChatGPT for some context here as well. I'm gonna use the same prompt as I used for merchant banks. Hey ChatGPT, please explain the role of commercial banks. Commercial banks, their roles in the financial system or markets, and how they invest. What is their role as an institutional investor? Please explain in paragraph form to an actual grade, undergrad, add examples and scenarios, give examples of popular commercial banks in South Africa and the role they play in practice. No bullet points, no list, just flowing paragraphs. Right. So on to commercial banks. And the role they play in investment markets. Okay, so commercial banks, often called retail banks, form the backbone of any financial system because they are the primary institutions through which money moves, right? So for an actual undergrad, it helps to see them as the main intermediaries that take deposits from the public and convert those deposits into loans and other financial assets. Their distinguishing feature is that they provide everyday banking facilities like current accounts, savings accounts, debit orders, ETFs, ATM access, and payment systems. All those are banking facilities. So when individuals and companies deposit money, the banks take on a liability, right? So if I take my money and put it in a bank, in a bank account, the bank takes on liability, right? It owes me that money now because it's on their possession. So when when individuals and companies deposit money, the bank takes on a liability, but it can then use those pooled funds to create credit by lending to households and businesses. This ability to accept deposits and create loans makes commercial banks central to the money supply, liquidity creation, and economic activity, right? In South Africa, banks like Standard Bank, FNB, Nedbank, and Absa operate at scale, providing everything from basic accounts to corporate banking services. So beyond everyday banking, commercial banks play a crucial role in credit extension. They provide mortgages that allow households to buy homes, personal loans for consumption, smoothing, and vehicle finance that supports retail motor sales. So in the corporate space, banks provide working capital facilities, trade finance, revolving credit facilities, and term loans. For instance, when a construction company in Johannesburg needs cash to buy materials before payment arrives from its clients, a commercial bank may offer a working capital loan secured against receivables. These lending activities are fundamental to keeping the economy functioning, and they rely heavily on credit risk modeling. They rely on credit risk modeling, default probability estimation, and capital adequacy considerations that actuaries can contribute to, right? And then, as institutional investors, commercial banks participate in financial markets not primarily to speculate, but to manage liquidity. Meet re- they as institution as institutional investors, commercial banks participate in financial markets not primarily to speculate, but to manage liquidity, meet regulatory requirements, and earn safe returns on excess cash, right? They dominate the money market because they constantly adjust their short-term cash positions. A bank that suddenly receives a surge of deposits might place excess funds into overnight or 1 month deposits, while another bank that experiences withdrawals might borrow short term to meet its funding needs, right? So these interbank transactions form the core of the South African money market. Banks also issue Banks also issue and trade certificates of deposits, which are essentially fixed term deposit receipts that one bank places with another, right? When Standard Bank has surplus liquidity, for example, it might buy a 3 month certificate of deposits issued by ABSA to earn interest until it needs the cash again, right? Commercial banks Commercial banks also participate in the bill markets by buying and selling treasury bills, bills of exchange, and municipal bills as part of their liquidity management. Right. Right. So treasury bills being backed up by treasury bills. Where am I? All right. Treasury bills being backed up by the South African government are particularly attractive to banks because they offer low risk, short dated instruments that can easily be sold if cash is needed. Similarly, in the government bond market, banks tend to hold short dated bonds since they must always be prepared to meet withdrawals, right? A bank's investment portfolio is therefore highly liquid and focused on instruments maturing within a year. This ensures that the bank can honor its deposit obligations while still earning interest on idle funds. So their role in investment markets extends beyond holding assets. So their role in investment markets extends beyond holding assets. Banks compete aggressively for retail deposits, which form the foundation of their funding base. They also increasingly act as intermediaries in the investment world by offering customers access to unit trusts, money market funds, tax-free savings accounts, and other collective investment schemes. Right? So, for example, a customer at FNB might receive advice on choosing an FNB branded an FNB branded an FNB branded money market fund, but that fund is managed either internally or through an investment arm like Ashburton, or whatever, right? Commercial banks therefore influence capital allocation by directing household savings into broader financial markets. Although they play only a modest direct role in equity markets, they do occasionally issue their own shares or debt instruments when they need long term capital to support lending growth or meet regulatory capital ratios. Okay. So in practice, South African commercial banks shape the financial market ecosystem by constantly recycling liquidity and linking retail savings to broader capital markets. A typical scenario might involve Standard Bank using excess deposits to buy treasury bills while at the same time issuing corporate loans to mining clients and selling its unit trust products to retail investors. These inter these interconnected activities allow banks to act both as credit creators and as large conservative institutional investors. So for actuarial students, the connection becomes clear. The same principles of risk management, asset liability matching, and capital modeling and cash flow forecasting underpin almost every decision a commercial bank makes, right? That is commercial bank. Now on to micro lenders. Micro lenders provide financial services in the form of loans, typically at the smaller end of the market. Micro lenders tend to provide short-term loans to clients who may not qualify for loans from commercial banks, although commercial banks are also increasingly moving into micro lending. Okay, so let us quickly ask ChatGPT for more content on this one, on micro lenders. Micro lenders. Institutional. Micro lenders. All right. All right. So micro lenders operate in a specialized corner of the financial system where the primary goal is to provide very small short-term loans to individuals who may not qualify for traditional credit from commercial banks. So for an actual graduate, it helps to see micro lending as a high volume, high risk form of consumer finance. These lenders step in where formal banks either cannot or will not lend, often because the borrower has a thin credit history, irregular income, no collateral, or a poor credit score. In South Africa, this market plays a significant development role because many households rely on microloans to cover temporary cash flow gaps, emergency expenses, or small business needs. Institutions like Capitec in its early years, African Bank, Wonga before exiting South Africa, and various registered microfinance companies fill this space, while even large banks are now competing through dedicated unsecured credit divisions, right? So the core role of microlenders is to extend unsecured short-term loans at relatively high interest rates to compensate for the much higher default risk. A typical scenario involves an individual who needs 1,500 rands to cover transport costs while waiting for month-end salary. A commercial bank, oh, oops, a commercial bank A commercial bank might not approve such a small, short duration unsecured loan, but a micro lender can process it quickly using simplified affordability assessments and automated credit scoring models. Using simplified affordability assessments and automated credit scoring models. Because the loan amounts are small and the terms are short, often 1 to 6 months, the focus is on speed, accessibility, and repayment behavior rather than complex a tongue twister, complex collateralized structures, right? So from an actuarial perspective, this market is particularly interesting because it requires sophisticated modeling of extremely granular risk, predicting defaults, pricing loan products, managing behavioral scoring, and forecasting cash flow volatility across thousands of tiny loans. Although micro lenders are lenders first, they do participate in financial markets in ways that make them institutional investors. They don't typically invest in equities or long-term bonds. They weigh They don't typically invest in equities or long-term bonds the way pension funds or banks do, right? Instead, their investment activity is the loan book itself, which functions like a portfolio of high-yield assets. A micro-lending business takes capital from shareholders or wholesale funders and invests that capital by issuing thousands of small loans that each generate interest income, right? So in this sense, the loan book is their primary asset class. However, many microlenders also place surplus cash temporarily in money market instruments or short-term deposits while waiting to fund new loans. Because their liquidity needs are immediate, they must always have enough cash to disperse. They must always have enough cash to disperse new loans and cover operating costs. Their investment horizon is extremely short. They might, for example, keep idle funds in a 7-day notice deposit at a commercial bank, or they may hold treasury bills to park excess liquidity for a month or two. So in the South African landscape, microlenders like African Bank illustrate how this model works in practice. African Bank funds its operations through wholesale borrowing and the issuance of bonds, then deploys that funding into unsecured personal loans across millions of customers. Capitec, while now a major commercial bank, originally built its franchise by providing small short-term loans to customers underserved by traditional banks, right? Combining simple products with rigorous risk modeling. And then smaller microfinance institutions operating in townships and rural areas also play a vital role by offering accessible loans to informal traders who need working capital. Perhaps a small shop owner requiring 5,000 rands to buy stock for the month. So these institutions often balance financial inclusion with sustainability. For example, they may stagger repayment schedules around social grant payments. To better align with client cash flows. Okay. Microlenders influence the broader financial system in several ways. Their lending activity stimulates consumption and supports informal sector businesses, which feeds into economic circulation. Their presence also creates competitive pressure or on commercial banks to innovate and broaden access to unsecured credit. As institutional investors, their loan books represent a large pool of high-yield consumer debt, which can even be securitized and sold to other investors, right? African Bank, for instance, has historically packaged parts of its loan book into asset-backed securities, which pension funds and money market funds sometimes buy. This transforms microloans into investable financial instruments and links the micro-lending market to the formal capital markets. So for an actuarial student, the micro-lending sector is a rich environment to understand the intersection of consumer behavior, credit risk modeling, capital requirements, product design, and financial inclusion. The key challenge for micro-lenders is balancing accessibility with sustainability, pricing loans accurately enough to absorb high default rates while still remaining compliant with regulations like the National Credit Act. So actuarial techniques are central to managing this balance, making microlending a meaningful and analytically demanding part of the financial system. Right, that is microlending. And now, okay, so let me break this one here, and then I'll move on to collective investment schemes.